Oh, I was muted. Ha 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 ha. Silly me. Okay, hi guys. I was like, what is going on here? And it turns out I was muted. So now we'll see if anybody can hear me. I was just saying I'm kind of like talking to myself like a crazy person. And I was wondering if I talk to me. I was wondering if that's crazy. I mean, we all talk to ourselves, right? Or maybe not. Maybe that's not a thing. I talk to myself. Or I think, I don't know, I can hear myself think. Let's put it that way. If I'm thinking, it's like a voice. Yeah, pretty much. I don't know. I'm kind of like a strategic thinker, so I always like, think to myself. I don't talk to myself a lot. Don't talk out loud, but in my head, conversation's always going on. Like this, like nobody's there and I'm talking. All right, good morning. Now people can hear me. Fantastic. All right, so now we will test the screen and see if that part works. If that works, we are going to have a webinar. All exciting. What is this little picture I see here? Oh, that's my HP from last week. That's right. I'm showing off my cool computer. Not last week, a couple of weeks ago. Yeah, I don't know if you get the impression of how wide this thing is. It's like, it's incredibly wide. It's 3 screens wide, basically, or 2 full-size, 2 big screens together is how big it is. And it's fantastic to take on a trip. It's so great to work with. The only thing is you have to carry, I have this thing that's made for carrying like art portfolios, and I wrap it around this and I carry it and it sticks out a little bit on both sides. And that base is attached. You can't take it off. It comes with it. But, it's heavy. It's like 25, 30 pounds, but it's a full desktop computer that you can take wherever you go. And I love it. So that's my commercial for HP. So meanwhile, can anybody see the screen at all? No? Yes? Maybe? Oh, how's poor Tesla doing? They've had some rough times. No, it's still 701. Why are people complaining? I thought they were down more than that. Oh, that's a target on Tesla. That's not the reality of Tesla. They're at 690. It's still not bad, though. Let's see. TSLA. Is it that nobody can see my screen? Or, oh, finally. Okay, God, man, the delays are ridiculous on this stuff. Oh, that's what people were freaking out about. I heard like 10 different people saying, "Oh, Tesla's dropping." It's like these are minor fluctuations when you're this high in price. All right, good. Now, definitely people can see and people can hear, and that is all we ever ask, right? So, where are we? Well, let's look at the market. So we're hovering around those strong bounce lines, and well, let's start with that. Okay, so we'll do a little basics. So strong bounce line. How do you get the strong bounce line? Well, we fell from, that's not the Dow. So we fell from 13,550 to from 35,550 to 35,050, close. So 500 point drop. You have a 500 point drop, you expect to see at least a weak bounce, which would be 20% of the drop. So obviously if it's 500 point drop, 100 point bounce. So step 1, 100 point bounce, that's a weak bounce. Step 2, and where's that? That's gonna be 35.1. And see, watch what happens here. Oh, and by the way, you always kind of round off to like the nearest whole number because it's, that makes more sense. So it's usually, and you don't count spikes. That's why the 5% rule is tricky, because you have to be like, you have to not be rigid in your thinking, like a lot of people want like the definitive thing. And it's like, no, where do you see the consolidation? Not, you spiked up to 35.50, but let's say we turned at 35, basically. If I can expand this a little bit. That's too expanded. All right, so here's the 35 line. And realistically, what do? We spiked over it, came back down, consolidated, rejected. That's that the short story of this, which took place from the close until 7:30, so the aftermarket stuff, we're throwing it out. It doesn't count. And we're going to say we had consolidation at 3,500, and then we're rejected officially when the volume comes back. And then you fall down to 35. This is 35.5. Then you fall to 35, even though you didn't actually hit 35. Obviously, you're bouncing off that resistance. And that means you're going to calculate the bounce. The bounce is going to be 20% of the drop is a weak bounce, and 40%, another 20% of the bounce would be a strong bounce. So it's going to be 100 points up to 35.1, and that's 35.1 right there. That would be called the weak bounce, and you can see the consolidation right at that point. It's predictable. Then 35.2 is your second strong bounce line. We went over that, and how much, by the way, how much of an overshoot do you get? A one zone overshoot. So 35.3 would be an overshoot. We don't quite hit that. We come back to 35.2. And again, this is all post, this is after hours. This doesn't count. Nothing that happens after hours matters. The volume is nothing. There's your volume compared to the volume here. It's, 1/100th. It's not even worth discussing. So all this is bullshit. You don't look at that. What happened during hours? During hours, we get to 35.2. We made it up to 35.3, but that was post-market, fail back to 35.2. And now we're kind of hovering around 35.2 with a visit towards 35.3. But it looks more like we're consolidating into this zone, and we're probably going to end up falling further down. And all the indexes are doing the same thing. They're all doing, they did strong, we're consolidating at strong bounce lines. Now, if they get over it, it's healthy, but the longer they take to do it, the less healthy it is. If it's a nice V, that's a very healthy bounce. So in other words, if they go up as fast as they went down, that's a nice healthy bounce. Look at silver, right? Here's a V, but then it stopped being a V and it started petering out. And where did it peter out? The strong bounce line, same action. So when you see something stop at the strong bounce line and it can't quite get over it, as soon as it violates the weak bounce line, you know that you're going back to the low and probably going to fail it. And the longer it takes, the worse it is, because it means that there's always sales and buys going on. So there's more and more. So in other words, every hour that the stock is hovering in a certain place means that there's an equal amount of sellers and buyers. There's an equal amount of sellers and buyers at the strong bounce line, right? So a fairly equal amount of sellers and buyers. Who will get exhausted first? What are you going to run out of first? Will you run out of buyers or will you run out of sellers? If you run out of sellers, that's when you're rejected from the strong bounce line and now you start falling again. But don't think of it like it's not some magical chart with like fairy dust on it. It's like this is telling you what's actually happening. There are an equal amount of sellers and buyers at a certain point. That's where transactions get made. The sellers and buyers agree to a certain price at a certain time. Over a longer period of time, more sellers and more buyers agree on a price. So if you ask one guy, how much would he pay for front row tickets to the Rolling Stones? And he says $1,000. And you say, okay, does that mean it's worth $1,000? We don't know, because the next guy you ask could say $100. But maybe the next guy doesn't like the Rolling Stones. Then you have to sort of tighten up your group that you're talking in, right? So now you got to think of like, of the people who are Rolling Stones fans, how many people are willing to pay $1,000 for front row tickets? That's how you start finding out the price. But then you need a sample. It's just any statistical analysis, right? You need an adequate sample of the population in order to make a determination of price. And even then, your poll, which is the price, is going to have a plus or minus some percentage variation. So the more of a sample you have, and that's what the 200-day moving average is the 200-day average of people who decided that they would complete transactions. So 200 people who actually had money and had stock and agreed on a price over 200 days, all those people said the price is X. That's powerful, right? That's a gigantic sample. And if you go to the 50-day moving average, that's the people of the last 50 days. Now, the thing you have to consider is that the people who in the last 50 days may have had better information than the people in the first 200 days. So you have to start taking that into account too. It's the 50-day average may be more accurate than the 200-day moving average because it's still a very adequate sample size. And those people have newer information than the people, obviously the same 50-day people are in the 200-day moving average, but the 150 days before that, those people had, 50 up to 200 days less information to make a decision on the stock. So even though you have 100 days of statistics in the 200-day moving average, that's some pretty old shit. That's going back 6 months. And don't forget, those are market days too, so it's not every day. So in other words, so that is 6 months. A 100-day moving average is a 6-month moving average going back. 200 days is a 1-year moving average. And so in other words, those people, that information that they were acting on was very old. So although the 200-day moving average has a powerful amount of people in it, it doesn't necessarily have the smartest people. And they're not dumb because they were because they're uneducated or they didn't know what was going on. They're dumb because they didn't have the kind of information that we have, because the guy who bought the stock 200 days ago hasn't seen the last year of earnings reports, hasn't seen the last year of news. Let's, take an example of jets. We just decided like we're getting out of jets because we don't like the current information doesn't match our investing premise from last year, which was that people would be flying again this year. They're not flying. They are flying again, but will they keep flying? We don't know. It's kind of dicey with air travel right now. So we're not having the robust recovery we thought we might have. This new COVID is around, so we decided jets is just too risky to take. But let's take a look at a chart, in fact, with the averages. Benny and the Jets. Let's see, Jets, Jets. Okay, so, well, there's nothing here. So this one should be longer. Oh, I see. This is only the 200-day moving average. So when we decided to buy Jets, it was way down here. And we were like, well, we think it's worth more than that. We took a position in Jets. It did go up very nicely, but now it started coming back down because the reopening, the Delta variant and all that, it just hasn't been as good as they thought it would be. So we're not making that 100% recovery. So at this point, we're pulling the plug because there is a danger it could go all the way back down. And we don't have this burning desire to own the ETF Jets. It's not that important to us. We'll probably get back in if it goes way down, but there's no reason to take a loss now. We have a small profit and we're going to get out. But point being that these people here had a certain amount of information, right? Then COVID hit. People have more and more information about how bad COVID is. It goes down and down and down. The transactions keep going down. The average keeps going down. But this average is taking into account all of this, right? And it wasn't a big recovery, so the average starts getting dragged down to where you are. Then people start doing this. But the people who are buying here didn't have great information on when the virus was ending. In fact, we didn't have the election information either. So the election was helpful. Didn't know who was going to be president. Didn't know if the virus was ending. We could have gone, Trump could still be president. We never would have done anything about COVID, or who knows what would have happened. But there's a lot of wild cards back then. But once things started calming down, people got confident and everything came back nicely. So better information. Now, that's a 200-day. But if you think about it, watch here. The 50-day moving average, right? People are going to be a little, you would think. Oh, I'm sorry, that is the 50-day moving average. So here's the 200-day moving average still going up. Okay, that's this. It's still going up because the average is still reacting to this spike up here. It takes a long time. If you don't fall too far below it, it's still going to get dragged up by this action. So this exerts a pull. Just think of it. Everything above it exerts a pull, and anything below it is pulling the other way. So since everything here was pulling up for a very long time, it's going to take a big move down before this thing starts bending the other way. Now, as you can see here, so they're still reacting off the old information. These guys with the 50-day moving average, they shake off their information quickly. Now, don't forget, it's 50 market days. So it's basically 2 months, pretty much 2 months, a little bit longer than 2 months. And so in the last quarter, let's say, at least it's definitely in the last quarter, have we found out new information? Yes, and it quickly comes down. The 50 quickly comes down like that. And that's what you call a death cross, right? When it crosses, the 50-day crosses below the 200-day moving average, that's bad news. And why is that bad news? That's because the 50-day people, in theory, have better information, and if there's a lot of selling pressure that's building up over the short term, you can expect to eventually see that reflected in the long term. So in other words, we're going to see a tug if the 50-day continues to go lower, and it's not that easy to turn the 50-day moving average, so it's already trending down. Even if things get better, it's still going to keep going like this for a while. That's going to start exerting a pull on the 200-day moving average. So unless things get drastically better, which nobody thinks they will, then you can pretty much predict that this red line is going to start trending down. And if they're both trending down, it's going to make it very, very hard for this thing to get back over it. So that's what I'm saying. So we said, you know what, Jets isn't worth it. It doesn't look robust. It doesn't look like it's going to recover soon. And macro-wise, with the news, we don't see that that's going to happen. All right. So there's a lot of factors that go into it, but when we point to a chart or when we talk about a 5% rule, it's only a part of the whole picture. It's got to be driven by the fundamentals. We have to make our decision based on why this stuff is happening. You know, not just, oh, here's a squiggly line on a chart and therefore it should be you extrapolate it outward. That's not how this works at all. And you've got to be aware of why did these things get made? Why did Jets spike down this is a weekly chart. This is a weekly chart. Why did Jets spike down that far? Why? So what happened in this day here? I don't know, frankly. I'm sure it's some bad earnings from a couple of airlines or something like that, and everybody freaked out. But then they go, oh, okay, it's not so bad. Whatever. And now, but the reality is they were right, because now we're back down here anyway. So, but the point is, yeah, you have to be aware, like something like this could be unusual. It could be a bad market day. The whole market could have gone down significantly, and so they got caught up in the flood. Or one airline could have posted bad earnings. Why did it spike down? Why did it spike up? If it's not a trend, the easiest thing to do is just basically throw it out, though. It's happened one time and never didn't repeat. Happened one time, didn't repeat. That's not something we're going to put into our averages. So when you're looking at the 5% rule, and I try to tell you, where did this consolidate? Well, this consolidated pretty much here. See, right around this zone right here is where we consolidated, which is basically 2750. So I would say 2750 is the line of consolidation at the top, and you're going to ignore this as a spike up for no good reason. These are little spikes, they don't matter. And then 2750 is a spike up. At the bottom, clearly 22 is offering support. So now we know we have a $5.50 range from $22 to $27.50. If it's $5.50, it's going to have a $1.10 bounce. 20% of 550 is $1.10, and so you'd be looking at the 2310, and then you'd be looking at 2420. And isn't it funny? Look at the 200-day moving averages right at 2420. No, I'm sorry. Wait. 22, 23, 24. Yeah, that's correct. 2420. So 2420 is exactly where the strong bounce line is. And that's how the 5% rule works. But the thing is, you don't need these frickin' charts. They're not important. The 5% rule is just math. The 5% rule doesn't care about the charts. We illustrate it by showing you, we illustrate it by pointing to a chart. But the reality is, if for years, only when Jean-Luc, who never has time for us anymore, but Jean-Luc he started drawing the charts for the 5% rule. He used to not have the charts. It used to be just a spreadsheet that I would do, and I would call it the 5% rule. And I was very anti-chart. I'm still very anti-chart. I think those people have either the TA people have calmed down, or the TA people don't sign up for our site. But the bottom line is, it's just I'm so not a chart person, and I don't put much stock into these things. But the 5% rule is much more accurate than any chart will ever be, and it's just math. It's just calculating where the support and resistance lines are in the market. But you can always figure it out by looking at a chart, but don't look at the short-term stuff. Look at the long-term stuff. Look where your consolidation points are, and you can figure out what's going to happen and where you're coming from, where you're going. And that is useful information, but you have to temper it with understanding why things are happening on certain days, or what's driving the market, or what's causing this move up and down and sideways. Because you have to then think about, do I take this as a valid move, or do I sort of ignore it because something else happened? And that's very important. You have to make those decisions. Robin says, is there a rule of thumb on a bull call spread when the call you sold should be repurchased to sell again later? I sold pets 35 calls for 6 and they're 360. No, there's no rule. Let's take a look at pets. Pets. Gallery view of pets, right? So PETS. So she sold the, what did you sell? The 2023. She sold the 2023, 35 calls for 6. Now I assume that you have some lower calls, so it's part of a spread. But you sold the 35 calls for 6, and now they're half of that price. You're up 50%. Now I assume you sold them in the last 6 months or so. That's fine. That's what it should be doing. It's supposed to be decaying away. Frankly, I hardly ever change them, but if it is something where I strongly believe the stock has bottomed and I want to take advantage of the next move up, then I'll buy them back and I'll wait for a better price and I'll sell them again. But honestly, you still have $3 and whatever to make, and it's not hurting you. And unless you feel that Pets is likely to go flying past your goal of 35, which is way up here, there's no reason to do anything with them. You're not really going to get much more money for selling the 32s or something like that. This is a nice bottoming zone, though. So if you wanted to play, the thing is, in the market condition right now, I'd rather be covered than throw caution to the wind. So it's like I'm not going to pay $3 because my fantasy of going to 35, which is what, $7 more. It's like 30% higher than it is now. So you have this. I'm going to pay $3 because I don't want to be capped at 35. You should be thrilled if it goes to 35 and gains $7. You should be totally. Who cares what you have to pay back the short caller? Right now, he's giving you $3 of protection for free, but instead you're going to pay $3 not to have protection. What's the point? And also, and then the question is also, would you buy that call for that price? Would you spend $3 to buy the 35 call? Because that's what you're doing. You buy it back from that guy, you're the sucker paying the premium to buy that call back. Why? He was the sucker. He paid you the premium. You're gonna take the noose off from around his neck and say, go away. Okay, don't worry about it. You're pardoned. It's like, you got the money. Let it run out. You're like the landlord kicking out tenants in the middle of the month and giving them their money back, right? You're like saying, oh no, you paid me too much rent. Here you go. Have a nice day. It's not how it should be. I know Pets is crazy and it has these spikes up every once in a while, but so what? Be happy. That's the thing. You got to be determined to be happy with what you get. It's like when you go to you go to an all-you-can-eat place, right? You go to a buffet or something like that, and you could have as much as you want, but that doesn't mean you should have as much as you want. And you gotta have self-control. You have to pick an amount that's palatable and that works and makes sense. And you've got to be somehow protected. So if you're gonna turn yourself into a naked long person on Pets, what's your protection? You have none. You paid money not to be protected. That makes no sense. So that's a rule of thumb. It's got to make sense. And if we didn't have headwinds against us, and if we weren't worried about the market doing anything crazy, that'd be one thing. Also, you got to look back and say, okay, worst case scenario, another bad wave of the virus, and we lock down again, or it gets back to the situation we had last year. What happened last year? Well, pets fell to 20. It's at 28 now. That's a pretty steep fall. If pets does fall to 20, never assume something can't happen again. So I mean, and anyway, you just fell to 24 something. If pets does fall to 20, what are you going to do? Okay, if you have the short calls, you buy back the short calls and decide what to do. But if you only have the long calls, your long calls are going to lose a serious amount of money. At that point, are you going to double down or roll them and spend money on the position and still be naked? Because if you're not, what's going to happen? You're going to say, "Holy shit! I can't believe I uncovered my calls, thinking we go to 35, and here we are now at 25. Where's 25? And here we are at 25, and you'll be saying to yourself, okay, I didn't cover them. I paid money not to be covered. It went down to 25, and now I'm going to be thrilled if I get my money back at this point, because now I'm down $3, $4, whatever. So then what's your plan? And if you don't have a good plan for that, then why would you be so aggressively naked and long on the calls? You got to think through the consequences of your action and make sure you're comfortable with them. So if you look at the portfolio reviews, oh, not here. Oops, log in. Excuse me. I don't have my tea. I knew something was wrong. Oh my God, how can I be doing this without my tea? So where was I? Can't actually, I'm going to lose my voice at some point. So how do we decide when we're done with the call? Well, first of all, and it's like I said, in the spread, I almost never buy out the short call. This one's up 58%. This one's up 74%. This one's up. That's not a short call. Okay, so the best example is, well, this one's up 74%, but what are we doing with IBM? I think we closed the position. We're done with we're closing the whole position. I'm not gonna buy it back and leave myself naked long on IBM with an $8.70 call, because I don't know for sure it's gonna go up, and why would I want to risk that money? You know, we made good money on the short calls. Oh, that's the wait. I'm sorry, it's a 110. I'm sorry, it's a 32.95 call. We're covered by what is now, I'm sorry, it's not up 74%. The short puts are up 74%. The short call is up 24%. But I'm not going to buy it back just because it's up 24%. You have to be, just prudent about what you're doing. It's like my intention was not to be in long naked calls. My intention was to be in a position. I felt that IBM would get to a certain point at a certain time. Now, the bottom line is, as we do all the time when we're doing our portfolio reviews, I'm adding up. I take the total, here's what we paid for the trade. And in the case of IBM, we paid nothing because these two cancel out, right? So we had an $8,000 credit on this IBM spread. And as you can see, first I don't know, they moved around, but this iteration of it was an $8,000 credit. Now it's net 26 minus 6 is 20 minus 2.5, 3. So let's say 17. Now it's worth 17. So there was an $8,000 credit. Now it's worth 17. We're up 25,000. We can check that by going here, and we say 16, 17, 23, 25. So we're up, as I said, so we're up $25,000 on this spread. The spread is a 8 times 3 is what? Wait, 8 times 30. It's a $24,000 spread. We're up the entire amount that we should be up. So we're done. Okay, I don't care what the call is. I don't care what the put is. I don't care what any numbers are. The bottom line is we're net cashing out at just about the full price of the spread. What was this? That is what I decided, right? Yeah, we're going to kill it. Yeah, that's what I said. Okay, was the you have to just determine whether or not that's a prudent thing to be in and whether you want to do something like that. And what was this other one? Then we had the futures now portfolio. And what do we sell here? We sold these calls. We sold these puts. Let's see, these calls are, oh, the Cowan, look at that. We just sold these in June. And they're up 50% already, 45.6% already. That's really nice. The FF short calls. Now, here's where you can make a case. These FF short calls, 1250s, are up 97.7%. They're only worth $75. But the thing is, they're November calls. So do I look at Cowan and do I believe that they're going to be chart? What was the number? I forgot now. June 35 calls. So where to go? Chart. There. Okay. Wait, what? Where's the disconnect here? The long call. Oh, the short calls. What the hell was I looking at? Oh, it's a CIEN. Silly me. Okay. So I'm so confused. I'm like, that doesn't, nothing I'm saying makes sense based on that number. The CIEN is a whole different story. There. So CIEN's at 55. Okay. And we had the oh, that's long call. Son of a bitch. Long call, short calls. Nope. I don't know what I was trying. I honestly lost that point completely. Were these the ones I was looking at? I don't know what I'm doing. All right. Maybe I was. Let's try it again. The future fuel. The future fuel 1250. Yes, for sure. This is what I was trying to say. I don't know how I got stuck on count. I don't know how I got to there. The future fuel 1250s. This must be what it's like when you go senile. This is really bad. Anyway, so the future, yes, and November. This is exactly the one I was talking about. I don't know why I was stuck in my brain on count. The future fuel 1250 calls. Let's do this step by step. FF. See, I need my T because I'm falling apart. The future fuel 1250 calls. There we go. 1250. Way the frick up here. Okay. And it expires. Now it makes sense. And it expires in November. It's already August. So we have September, October, November. We have 3 months. So why don't I want to spend $75 to buy that back? Because I don't see why I should spend $75 to buy back when we're only at $8 now. We have to go up 50%. If we do go up 50%, of course I'm going to regret not buying those back for 75. But you know what? I'm still going to be pretty freaking happy that these guys go $5 in the money and go from 20 cents to $5. And all these prices are wrong anyway because of the they paid out a 250 special dividend, screwed everything up. So the power options doesn't pick that up. So power options assumes that we have the new options. It doesn't keep the old options in power options, and the new options include a 250 obligation that we don't that's not in there. So we have to play with the adjusted ones, but it'll be straightened out in 3 months. I'm not going to really worry about it. It does mean it shows that we have $4,000 less than we really do. But the point being, so when would be the time to buy it back? There's not a time to buy it back. There's no reason to buy it back because it's only $75. But out of principle, I don't believe we're going to go up 50%. And if we go up 50%, we're going to make $7,500 here. So what am I going to whine about the fact I could have made $8,500? Statistically, it's smarter for me not to, it's smarter for me never to spend that $75 because I'll save $75 20 times before the one time that ends up costing me money. The point is when you says the whole concept of PhilStockWorld is we say be the house, not the gambler. Being the house isn't just about taking the other side of the bet. There's a way you take the other side of the bet when you're at the casino. And the way you take the other side of the bet is you play the odds all the time. You play the statistics. So you don't see the house when roulette wheel goes red 10 times in a row. Highly unlikely, right? But it happens. So the roulette wheel is red 10 times in a row. And does the house say no more betting on red? No, that would be crazy. It's always the same 50-50 possibility that red or black comes up. Well, not quite 50-50 because they got a green, which screws up the whole thing and puts it in their favor. But that's exactly what it's all about. The fact that there's a green chip or one or two green spots on a roulette wheel means that it's not a 50-50 chance that it comes up black, black or red. It's actually less than 50-50 that it comes up either one, because sometimes it comes up green. And because of that, they're not paying you the proper odds of the spin. And that means every single time they spin the wheel, you don't have a 50% chance of winning. You have a 47% chance of winning. But you know what that means? And this is why the house always wins, because what it means, that little teeny 3% advantage the house has, and remember, it's one number out of 30 numbers, right? That's 3% advantage. That 3% house advantage, every time they spin, is just like them digging into your pile of chips and taking 3% every time. Whether you win or lose, they've got a 3% advantage. And you don't see it because you're getting the money, like you double your money. They don't take any of it. You put $50 down, you hit your color, you get $100, right? And if you lose your color, you lose 100%. That's back and forth, and you feel like it's even. But the problem is sometimes every 30 spins, basically, statistically, they take your money without it being black or red. They take it from both the black side and the red side. And yes, somebody bet on green too, so he won the money. But either way, statistically, you're not getting paid what it's worth. And that means that every time, over time, they are taking 3% of your money. So basically, after 35 spins of a roulette wheel, they're going to take all your money. You lose. And go count. Okay, you go to a casino and count how many times you can play roulette. Put the money on the table and see how long your chip pile lasts. It's probably going to last. You can be lucky, you can be unlucky, but basically after 35 times, you're going to have significant damage. The funniest thing with poker, we had a PSW conference in Las Vegas a few years ago, and we were all playing poker at a table. And in poker, we played a tournament style, which means everybody puts in $100. So 10 people at a table, we put in $100 each. So there's $1,000 on the table. And after a couple of hours of playing, we counted the chips, and there was only $700. The house had taken $300 in what they call the rake, where all they do is take $1 or $2 or $3 out of every hand. But after 100 hands, they take $300 out of your pile. And if we kept going and we played all night long, they would have all the money. It's guaranteed for them. Every time they play the game, they take a few bucks out of the pile. That's their rake. And that's what we do too. When we sell options, we're taking a rake. But it doesn't work if you give the money back. If you give the money back, that's not going to make you're not winning. You took the money, let it ride, let it dilute. Of course, if you have a strategic reason to change your mind based on better information or whatever, that's fine. There's nothing wrong with taking a chance once in a while if you feel strongly about it. But don't make it a habit, and don't say, Phil, when's a good time to do this as a rule of thumb. There's no good time. You should wait and collect all your money. Just like a landlord, you rent your apartment. Maybe the next guy would have come in and rented it for more money. But you don't just keep kicking your tenants out and saying, I hope somebody comes along and pay more money. You got a paying tenant, let them pay for the month. At the end of their contract, they'll leave. Then you're going to find somebody else. But you can't always be looking to get better. Everything can't always be nothing but looking better. If there's something major happening, if you think this thing bottomed unfairly, if you think the earnings were misinterpreted, like who are we talking about today? I forgot. Oh, IGT. How ridiculous. I've never seen anything like this. They had a fantastic earnings report. I wrote about that here. They had a great earnings report. Revenues are up. Earnings are up. Earnings were a huge beat. They had so much money, they gave a $2.50 dividend out to the stockholders. And now everybody's like, and the stock sold off like crazy. I'm like, these guys have so much money, they don't know what to do with it. So I definitely expect this line to hold. This trend line should be up, and they should be at the bottom here. So we actually did get more aggressive. I said, let's take advantage and roll out 20s. So our 20s are $4.15. The 30s are $8.15. So it cost us $4. Not the 30s, it's the 12. Sorry, the 12s. So it's costing us $4 to roll down $8. So we're getting for 50 cents on the dollar, we're rolling down. Now, keep in mind, we're rolling from the 20s, which are at the money basically, to the 12s, which are deep in the money. So we're buying $8 of intrinsic value for $4. So think about that. We're buying $8 of in the money value, of in the money strike for $4. So if there was some way we'd be guaranteed it doesn't go down in value, this would be this is a no-brainer of the century, right? Why would you not do this? It doesn't make sense not to do that. Even when you buy a house, if you buy a car, if you are able to get it for half of the market value, you should totally buy it, right? But you would have the same argument. Okay, a house or a car, you'd say, well, what if it goes down in price? What if it goes down in value? This is the problem people have with stocks, because you don't think of a stock as having a definitive value. I do, because I'm a fundamentalist. But traders don't think of a stock as being a thing that has a definite value. And that's why there's so much mispricing in the market, because they think it's binary whether it goes up or down. But I'm telling you that IGT at 20 is not, to me, a binary thing. IGT at 20 is ridiculously underpriced. And therefore, anything I can do with money that enhances my position of IGT at that level, I'm going to do it. And see, we're up 3% today. So nice. Where's my thing? That, there. So IGT. Yeah, that should be a top trade. $3.8 billion is the market cap now. The earnings are up. The earnings are up here. $3 billion are going to be I'm sorry, it's 2021. They were $3 billion last year. This is with Vegas closed. They still made $3 billion, had $3 billion in revenues. They lost money, but now they're going to make money. This year they're going to claw back and make some money, not much, but a little. Next year, still growing revenues, still but getting back to this long trend. 270 million, fine, and 270 million already is 1/10 of the market cap. But in a good year, these guys could make much more money. They can make $500-600 million. So they're going to be a fantastic earnings company in the future. And they're beating all their estimates are being beaten now. They kicked ass this quarter, and people are just not. I don't know what they expect. I really don't. But it's crazy undervalued, so we like it a lot. Okay. So anyway, I mean, it's a great long-term hold, 2023, and we're looking for it to go. We rolled out 20s down to the 12s, and we still have the short, whatever we have, 27. So we're looking for it to get to 27, which is where it was recently. Nope, that's not IGT. just coincidentally also works out at 27. So 27 was the previous high. We think we'll consolidate in this area and eventually get back over 27 and stay there. And again, it's a stock of the future. They're into the sports betting and things like that. And IGT is extremely big in the casinos and the racetracks and the Indian places and everywhere they have gambling. But they're also taking a big lead on sports betting. And I think you'll start seeing sports betting in bars and stuff like that. So that's going to be a big rollout. There used to be a thing in Vegas. I don't know if it's there anymore, but I don't know if it was IGT either, but it was really fun. But then this is so many years ago, my dad was still alive. So we're talking before 2000. And they used to have a touchscreen TV. So you go to you'd be in the sports betting place of a casino. They had touchscreen TVs in front of you. And you would bet on every single play of a football game. So in other words, when the play begins, they would be a bet. They would have a bunch of what they call proposition bets and say, will they make a first down on this trade? Will they make a first run? Will they make a first down on this series? Will the quarter, is this a passing or running? Oh, by the way, I made so much money because back then I was a super Giants fan, and I knew every single play the Giants, every single play the Giants were going to run, I knew what it was going to be. So I'd be like, pass, run, this, that. I'd be like, I was like having the best time playing that thing. It was only a penny. It was a pennies game. You'd make very tiny little bets, but it was so much fun when you're watching the game to bet on each play. And I love that system. I don't know whatever happened to it. I haven't played it since my dad died. I don't even remember we used to play it downstairs at the MGM. Anyway, so that was really fun. But the point is that things like that will pop up again in bars, and the technology now is obviously better, and they'll maybe do it on phones. Who knows what they're going to do? But that's the kind of stuff IGT does, and it's just it's a little bit of money here and there, like just like online poker and stuff like that. But it can become a big money maker, and the trust issue is so big. It's not like there's a moat of trust that these companies have where not every casino and not every major gamer is going to trust any old company to run their gaming tech. So these guys have the trust and security that you want to move forward. Anyway, I like them a lot. I think they're a fantastic company, huge growth opportunity, and very underpriced. So that's that. SunPower also crazy underpriced. It was FF short. Thanks. Somebody's paying attention. A couple of people said it was FF. I don't read this while I'm talking though. This is on a window, the questions that I don't think you can see them, but I can see them. So there you go for that. Hang on, I am going to get some tea because I'm going to run out of words in a second. Be right back. La-di-da. I think I'm gonna need some tea. I just thought I need some tea, that's all. All right, where are we? That didn't take very long. What have we got here? Mint green tea. Ooh, that's very crispy. Good. Okay. So, but let's go back to yesterday. Let's talk about what we're really doing here. Is we're attempting to cut back in the money talk portfolio. We only found 2 positions we really want to cut. In the future is now portfolio, these are the kind of positions you really cut over any kind of short-term activity. It's just we only found 1 that we could cut out of this one, so that's not really good. I would have preferred to have cut back more, but also we're already 166 out of 189 is cash. Okay, so obviously that's because we net out the money and so on and so forth, but there's not a lot of cash in these positions. That's the point. So even if we cash them in, we're not raising any cash, and we're not uncomfortable with the downside consequences of what we do have, and we've got tons of money to make commitments with. So in other words, let's say the market drops 30%, and this 23,000 turns into minus 50. All right, that means we'd be down to $100,000. Let's say of total value of the portfolio would drop to about like $100,000. But everything in the market would be 30% off. So then let's go SPY. Oh, not SPY, SPX. So even if we don't react, and even if we let it go, 30% off goes from 44 to like 30 something. Wow, you can't even see it on that chart. We'd be down around here. Okay, back where we were in 2020. We would lose all the gains that we've had so far, and coming back here, that'd be a 30% drop in the market. So right around this level where we are here at the top, where basically we would be the 2019 highs, and here, and what, you know, whatever catastrophe befalls us, we're down to here. But the thing is, if we had, well, we already know this though, because this is when we started our portfolios. We started our portfolios actually in October of 2019 for the most part, and but we weren't very heavily invested. This is where we got lucky. I wasn't really, we started the portfolios in October. We added a few positions, but not many. We were waiting until the January earnings, but then the COVID thing hit. So I was very cautious about putting money in. Then the market collapsed, and then we went gung-ho crazy because I said, well, this is stupid. You know, so come March, you know, things got so low that we were like, well, this is, again, it's fundamentals. It's like, okay, yeah, there's a virus, they're shutting things down, blah, 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 but it's not going to end the world. So, you know, we were investing hand over fist, and we made X amount of money. But the point being, if we drop back to these levels, and we know that that's the bottom, and we know it's going to get back to here, we already know that we can make 100% of our money back. So the hedge is the cash. The cash that we're going to have to invest here on a big drop means that we're going to have plenty of stocks that we can buy that will give us easy doubles. And you know, obviously easy doubles. We're, you know, we have positions here, and we write them down. I mean, it's like here, this one has a 1,589% upside potential. You know, this one has 32% left to gain. This one has 349% upside potential. Viacom has 306 upside potential. So it's not a double. They're going to triple. We're putting $7,000 to work to make $22,000 more. To make $22,000 more. On what was the other one? SunPower. So yeah, in SunPower, we have $3,000 at work, and we're going to make $11,000. All right, and on the big one was gold, and on gold we have, well, it's the big return. It's only $1,100. It's not even money. It's a credit. There's an $1,100 credit, and it's going to return $18,000. So, you know, obviously we don't, now you have to be wary of your downside. In the case of this gold position, what are we obligating ourselves for? We're obligating ourselves to own $23,000 worth of gold. Well, yeah, but if we're going to make $18,000 on the upside, and our downside isn't losing $23,000. Oh, gold isn't going to zero. Barrick Gold isn't going bankrupt. That's why we do this with like great stocks. Maybe they'll lose half. So our risk is not $23,000. Our risk is not owning 1,000 shares at 23. That's not the same thing as your risk of loss. Realistically, we would be shocked and amazed if we lost half of 23,000. So our risk is more like $11,500. And knowing that, that would take up maybe $5,500 in buying power, means we could easily go 5 times on this one without really stressing ourselves in a $200,000 portfolio. So if we wanted to, we could add 5 times to this and then make 5 times 18. There's $100,000 right there. on one position. We could easily make that if there was a downturn that made us feel that this was the way to go, depending on the type of downturn, how silly it was this thing sold off, so on and so forth. But you always want that. When a sector sells off, you always want to look for who's the best in the sector, and can we play that? Have they been unjustly dragged down with the rest of the sector? So now let's look at the long-term portfolio and see what we did there. Cashing out while we can. It's a good point. Good point, Phil. Okay. Back to the S&P chart. Okay. If you're gonna take a profit, here we are at like 3,200. Okay, here we are at 4,400. So 1,200 points up from 3,200 is what, a 35% higher, or whatever the hell it is, right? 2,200 is back here, so we're 100% off the low. This is a midpoint, and this is where we are now. So 50% was 30. So yeah, if you're 2,200 here, 3,200 is the halfway point, is 50% up. Now we're 100% up. Okay, you're 100% up, and you haven't really had a pullback. We had a little bit of a pullback at the halfway point, but that's what you're supposed to have. Then we went on to 100%. We haven't had a pullback yet. The odds are very, very strong we're going to have a pullback, at least a week retracement of the run being 22 to 44. It's 2,200 points. 20% of that is 400 points, right? So there should be a 10% correction in the market soon. Okay, we might go up 10% first, and then correct 10%, and then correct 20% back to 10, but at some point there should be a 10% correction. That's when we'll consider getting back in. It'll come back to the 200-day moving average. In this case, it's the 40-week moving average, but it's 200-day moving average. And it'll come back to here. And then we might be interested in buying, depending on how and why it goes down. But the chance of it going down is extremely high. So the thing is, with every position we have, why do we want to ride that out? Do we love our position so much we want to ride it out? You don't know if it's going to be protracted. You don't know if that trend line is going to hold, if the 200-day moving average is going to hold, or if the whole thing falls apart. We go back into like a full-blown lockdown, and the virus is rampaging and blah blah, and everybody and already you can see how everybody's blaming each other. They blame each other for Afghanistan. Wait till you see people trying to blame each other for the virus in the politics. So, and the money and the debt and the blah, there's just so much. So, who knows what's going to happen over the next few months? But the bottom line is, it's there now. It's happening now. This COVID is spiking all over the place. You can't ignore it. And the market's super toppy. Things are expensive. There's no good reasons to stay in that heavily. So you got to look at all the positions and say, I kind of would like to cut back. Where can I cut back? And like I said, those two smaller portfolios are so much in cash, they're basically bulletproof. The long-term portfolio, on the other hand, is only, actually it's not only, it's a lot. The long-term portfolio has 1.1 million in cash, 1.2 million almost out of 2. So, it's 60% in cash already. I want to get it up to like 70, 75, 80% in cash. So what are we doing? We're taking positions, and we're saying, is this really worth keeping? So in a big market downturn, I'm sorry. So I was saying, the point was I was making here before I got started, I was saying, when do you sell? You sell when things are high. If you wait until things start crashing, all of a sudden, all your short puts are going to get really expensive, and you're going to have to pay more to get them back. Your calls are going to start getting damaged. You're going to have a hard time selling them. The short calls will still have a lot of premium in them because the VIX will go up. You have to be aware of what happens in a downturn, because you're not going to get good prices. So you can get whacked in your portfolio if you have to sell in a panic when the market's dropping. And again, low volume rallies should be a big concern to you. It's got to be scary when you see a low volume rally. Here's a low volume rally. We had a low volume rally, which I complained about at the time. And this is why we cashed out in September, October. I wasn't happy with the market being at 3,000 back then. And we went up to 3,300. Exactly what I just said. We went up 10% before we went down. But boy, did we go down after that. But what happened? Look at the volume. Double the previous volume. Double, almost 2.5 times for a sustained period, for a month. And you know what? There simply are not enough sellers to buy it. There's not enough interested parties buying stocks, and that's why it drops like a rock. And it takes a long time before the buyers exhaust. It's not enough interested buyers to buy the stock. It takes a while before the sellers exhaust themselves. And that's why you get these kind of severe drops when the market spikes, when the volume spikes. And you can see this is a bad rally. When you see a rally where every time there's volume, it corresponds to a spike down, then you know you've got problems. Okay, you know that it's dangerous. So if you're going to be cashing out ever, you don't know for sure where the top is going to be, you should do it and not regret it and just say, okay, this is a good time to cash out, because everybody wants to buy our stuff. Right now, it's easy. You snap your fingers, you get your price, you sell, you're out, you're done. This is the time to sell, not when nobody wants to buy. That's a terrible time to sell. Not only that, though, but it didn't happen this time, and maybe it won't happen again because computers have advanced. But in 2008, we couldn't sell. The freaking brokers went down. The trading exchange, the trading online went. Not only did the online stuff go down, but you could call your broker and they couldn't handle it. Everything went down. It was total chaos in 2008. You couldn't sell if you wanted to. And especially not a limit order. There's no such thing as a limit order. Everybody's selling at market, and you were lucky if you got it filled. And that is a horrifying way to sell. You can lose a fortune doing stuff like that. So the most dangerous thing is puts, because the puts, as the market drops, several things happen. The puts obviously get more expensive because you get closer to the strike. The VIX goes up and increases the leverage of the puts. And also the brokers sometimes tighten up the margin requirements and force you to end up being forced to sell certain things, especially if you don't have a lot of cash in your account. So we took a really hard line on the puts, on the short puts, and we took a hard line on stocks that had a lot of short put exposure. So as you can see on the puts, we had, I don't know, what are they, 20 of these? About 20 of these. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Oh, 12 to 22. Okay, 12 to 20. So 12 of 22 puts gone. We cut our exposure by more than 50%. And we sold anything we were even a tiny bit uncertain about. Oh, see, I said pets is a keeper. I like pets. RRD, I love RRD, but kill it. It's up 50. Why do we kill RRD? Because it's already up 50%. Not because it's bad, but it already gained 50%. It's got 16 months to go. And I got to wait now 16 months for the other 50%, plus it turned down anyway. So we made 50%. It's looking a little weaker. What's the point of staying in it? OIH, we don't have a really good premise for being long on oil now, so that's out. Macy's, don't know how it's going to go with the retail, so that's it. And plus, we just had that horrible consumer confidence report. Labor, I said I really like. Harmony, we just, we just increased our Barrett gold position, but Harmony, we're upset again. We don't like them. They're up 75%. Why stay in it? ING is up 52%. Why stay in it? GS up 86%. Why stay in it? Ford, $60,000 is too much bulk. I guess I mean that we're obligated to buy $60,000. Is that what I was talking about? What am I talking about? Yeah. So the $12 puts is $60,000, and all we're going to make is $8,000. It's not worth it. We can take $60,000 and make $8,000 very easily. So there's no real reason to let it ride on Ford. Do we think Ford's bad? No, of course not. But we do think it's volatile. It's a clearly volatile stock, and we don't know what it's going to do. And there's no reason to tie up that kind of buying power. So then we get back to the, I wish this was more connected. So then we're getting into the section of the dividend payers, CIM, Tanger Factory Outlets, and Total. And they're all paying 7%, these guys. So, oh, I wasn't very consistent with saying keeper, was I? Thought I was. Anyway, so, CIM dividends, we're getting called away. SKT, we have them with the, we like them with the dividend. Total Energy, we will be called away. So, we already sold the calls and it's expiring in December. We're not gonna bother messing around with it. We're just gonna let ourselves get called away and be done with it. APO we're keeping, Alibaba we're keeping. Alibaba we're keeping because it got so cheap. I would get into it now as a new trade. And I know it's messy, and I know China's dangerous and all that, but this is a long-term portfolio. You have to ride out. You have to go look past the current things. Big Lot's not exciting. Kill it. Berkshire Hathaway, we're so far in the money that we're killing it. China Mobile we're stuck with because it's not tradable. Cisco, we're killing it because it's made too much money. There's nothing left to make. We can only make $4,000 more. So why not take the $56,000 and cash it? Dow, we just took it, so it's keeping. Facebook, we're keeping. It was funny, I kind of went back to the keeper thing. Somehow we gapped out. Fidelity, we're killing. Because again, 9,000 out of 12,000. So I can take $9,000 and cash it. And over the next 18 months, I have to find a different way to make $3,000. That's not hard. So we'll just get back to cash. It's better to have the cash. Gilead, too, $80,000 of cash. So we cash it and take $80,000. I don't care how good Gilead is. I can do better with 18 months than make $20,000 on top of 80. So we cash it. Gold, as I said, keeper, of course. I said I want more. HBI, keeper. We like them in a crisis. And they're only 7 out of 20. So these guys are going to make $13,000 more, almost 200% more is in this trade. Hewlett Packard is a keeper. IBM is IBM. We made too much money, so we're killing it. Why? And here's I apologize if it's too shorthand, but I mean I said $35,000 profit is potential, but it's 145. It'll cost us 140,000 if we get forced to own it. Of our buying power. So I don't want to do that. I don't know why should I risk having a big chunk of my buying power taken when the market's down? See, I'm being forced to own IBM as opposed to choosing to do something else. So I don't want to be forced to own IBM if the market drops. I might end up buying IBM, but I don't know yet. I don't know what's going to look good and what's going to look bad. I do know, though, I don't want to have a big chunk of my portfolio automatically tied up when all I have to do is cash this out and put the money to work elsewhere. Intel. See, now Intel, I really didn't want to sell this one. So I said, we can't, all right. So I said, let's buy back the short puts and remove the danger. And that would leave net 53 on the 75,000. Still a good upside. And And I said we start out with 15,000, so we're already up 200%, 22,000 more to gain. But if we're buying back the puts, that puts us in for 21,000, and with $17,000 left to gain. And they're like, oh, that's no good then, because we end up being 21,000 with only 17 left to gain. And although that's still good, it's not. It's you know, getting what, 75%, 80%. It's a great gain, but it's not enough to justify leaving 53,000 that we could just cash out and put to the side and not worry about it. You know, I said we can easily make 30% on 50,000 over 18 months. So let's just, you know, let's put it into a trade that can triple up instead of a trade that can maybe double up. And again, one that's more nimble. So Lloyd's, I love it, but we got to kill it because the risk is there. 3M we're killing. They're very disappointing. I don't understand how they don't make money when everybody wants their masks. Philip Morris is a keeper because they pay a 7% dividend. So if we get assigned the stock, I mean, it's like, okay, great. In a bad market, if you get assigned a stock that pays you a 7% dividend, that's fine. Micron, we cashed out the bull call spread and kept the puts because in that case, we're like, yeah, fine, assign us a stock. What do we care? 55. We come in at $55 if we get assigned. I want to own Micron at 55, therefore I don't consider the short puts a problem. The bull call spread, though, it already has a good profit. There's no point getting it. NRG, we're getting rid of. PAA is effectively half cashed out anyway. And what do I mean by that? With Plains, it's another stock ownership position. See, we have the $5 call that expires in January, so we're definitely going to get called away. So we're going to have 4,000 shares with 40 short $10 calls. The stock's at $10, so that's fine. So basically, this position will be cut in half, and half of this money, which is let's say $60,000. So $30,000 will be returned to us in the next few months on that position, no matter what we do. PBR, of course, getting rid of that. And again, that's South America, too much uncertainty, so on and so forth. Pfizer, we made all but $3,000 on the trade. So even though it's way up here and it's totally safe, it's like, screw it, let's take the money. PHN can double up, so we like it. QSR, we like it, and it's a small entry. REYN, we just doubled down on. We're keeping that one, although they're having a bad day. Rio Tinto, we are keeping because we think that, oh, that's right, they put out a special option. They put out a special dividend and screwed up all the options. So it's silly. It's kind of like that other one that we were looking at before. They screwed everything up by putting out a special dividend. SunPower, of course, a keeper as usual. AT&T is always a keeper. AT&T. You know, it's funny because I mean, I'm sure like your great grandfather probably said buy AT&T. It's like that was never wrong. Okay, everybody's parents told them to buy AT&T, and everybody's grandparents said buy AT&T, and they've never been wrong. It's always been a good stock to own. It's always paid a great dividend. It's not a complicated way to play the market. Just frickin' buy AT&T, leave it alone, let it pay you the dividends, let it accumulate, let them do their stock splits, and you get rich. You know why? Because we all use phones. That's why, because everybody has a telephone. Trox has got plenty left to gain. UBS, no, I'm not. I'm just not excited with the bank, and we're at 10,000. We can only make 25% more money. It's not worth it. Viacom, obviously, keeper always. Valero, same problem. Not too hip about the energy. VTRS, we're getting rid of, even though it's pretty new. We like it, but I don't love it, so it's not worth it. Wegmans is a short, so we're keeping it. They've been all over the place. We actually hit our mark. We were looking for 240 on Wegmans furniture. W. See what happened? They went down. They hit our target on the nose, came all the way back up to 320, And now they're doing that. Now, see, there's one where you could buy back your short puts and your short calls and play the channel, because they're crazy in the channel, aren't they? But on the whole, we think this is the right price. So I think they're going to just drift down to there. Not worried about it. It's a good trade. And lots of W stocks. Walgreens, 64,000 out of 75,000 is made. It's not worth it. For 11,000 bucks is 20% over 16 months. It's not worth staying in. Wheat and precious metals, they're only at 7,500 out of 30,000, and we think that they're gonna just keep climbing, going up. Not from today, but generally we think Wheaton's in good shape. And then Western Union, I'm no longer excited about Western Union, so that's it. When you get to this kind of a market and you're trying to like pare down your portfolios and cut your positions, you got to be like, if anything, any teeny little thing bothers you about a position, just kill it, move on. Okay, every one of these positions we're going to put back on a watch list, and when they get cheap again, we're going to want to buy them. Here's Valero. I'm not excited about Valero. Kill it. But you know what? Valero is going to go on a watch list, and if Valero gets back down to 40, we're going to be buying it again. Maybe it never will, but the point is that's what a watch list does. We look at the stocks, we watch them, and if one of them gets really cheap, obviously we go back and we analyze and say, why did it get so cheap? What happened? Why did they come back to this price? But that's why we have the watch list. Stocks do come back to any old price. Through no fault of their own, stocks can go much lower than you would think, and that's the time to buy. But it only works if you understand what the real value of the stock is and act upon it. That is the trick to this whole thing, is you've got to have a value in your head that you stick to, and you've got to act accordingly. It's not a spectator sport. Ooh, Tom says the strong bounce lines just failed. Let's get back to the live action. Oh no. What happened? Well, what happened? Well, who said something? Holy cow. Well, there you go. As I said at the beginning of the show, it's the strong bounce lines are likely to fail. I didn't know it was going to happen while I'm talking, but that's how it works. And again, the 5% rule. The 5% rule is better than any TA system out there in the market. It is better than anything people use to predict what's going to happen. And why? Because it's based on the way people trade. It's based on the way, more importantly, it's based on the way computer algorithms trade. So in other words, it's effectively a digitized version of Fibonacci sequencing. Fibonacci sequencing is an incredible thing that you see all throughout nature. It regards the natural ebbs and flows of any series system growth. So when things are growing, they grow at a certain pace, then they contract a little bit, then they grow, then they contract, then they grow. There's pauses. These are all very kind of predictable in nature along the Fibonacci sequences. I've written in the strategy section, in the education section, you can see this stuff. I've written extensive outlines of it. The 5% rule is something that I realized when I was when I used to consult on Wall Street, and my father had a firm called CHSM, and he was a systems analyst, and he designed some of the early trading systems for the Wall Street firms. And we would be called in to consult, and it was my job to translate, and I would translate my dad and his programming team did not speak Wall Street, and the Wall Street guys, of course, did not speak COBOL or coding or anything like that. So it was my job to be the effective translator and be like, well, what he's saying he needs is this, and then I'd be like, okay, so what my dad's team is saying is they can do this but not that, and that's in having all these meetings with all these bankers back in the days, and this is the 80s. It became apparent to me that although everybody is trying to design a unique system to trade the market and act on certain signals, they would all end up converging on the same signals in the same systems, even if they didn't intend to. In other words, two people blindly designing a system are, look, if you're designing a system to pick the top and bottom of a trading range, right? Here's a trading range. So when do you buy and when do you sell? And now you've got to put a rule in. This is the problem. So these guys, you can't go by your guts because you have to explain it to a computer. So now you take your gut out of this thing and say, okay, so what do I tell the computer? Well, I'm going to tell the computer that when you hit the 200-day moving average, this week's days, okay, 50 days, sorry. When you hit the 50-day moving average, it's a buy signal. So we're going to start accumulating when it hits 50-day moving average. It's going to be a buy signal. Now, when are you going to sell? We're going to sell when it's X amount over the 50-day moving average. But as you can see, that ends up to be a pretty predictable line too. Okay, so we think that if it gets 10% over the 50-day moving average, that's probably time to start taking a profit. So what happens is, because, and some people may say 5%, some people may say 7%, but you know what? Nobody says 8%. It's 5, it's 7.5, it's 10. People don't pick in between numbers. People don't say 7% over. They tend to pick flat round numbers. And that's what makes the 5% rule work, because the human tendency to do two things. It's also everything rounds off. That's another reason you end up with a 5% rule. Everything rounds off, and there's no such thing as a random number. Another thing people do not understand is the random numbers are not random. They're just generated by computers. The computer generates a very large sequence of numbers and picks one, and that number should be theoretically random, but it's not, because it can only possibly have come from the pool of numbers that were programmed into it. So it is not a random number. It is a number that would have come up every single time you ran that program at that exact time. That's the number that would come up. Not random. If you know the code, you can predict almost all the numbers that the computer will pick randomly. If you know the exact time, it's going to pick the random numbers. So a lot of things people think the computer is doing uniquely is not unique at all. And when you have millions of computers, just like we were talking about before, when you're doing a survey of people, it's a survey of computers now. You're doing a survey of computers, and although this programmer may have said this and this programmer may have said that, they all round off to the same general area. They all do this, and eventually things start to coalesce. And the points where the buyers coalesce and the points where the sellers coalesce, they have become intersections in the computer, and those intersections tend to form up very much like a Fibonacci sequence. And in this case, they form up along 5% lines, because it's a computer, and because of all the rounding, and because of all the guessing, and because the people who design the programs and the programmers aren't even on the same page. And so they end up doing an approximation of what each one wanted. So they take what you said and they kind of approximate what you said into a computer program. It's not really doing what you would have done under the same conditions. So anyway, the short story is, though, from that observation, I started trying to think about how it's really working, and that's what the 5% rule is. It tells you that the larger the index is, the more liquid it is, the more it's traded, the more you're going to adhere to the 5% rule. So it works best on things that are traded heavily, works very poorly on things that are traded lightly. And also the real key to the thing I for many years I was trying to figure out why it was working, why it wasn't working, and I realized finally that it was because of spikes. That you have to ignore spikes. This is a spike. What happened here was abnormal and had nothing to do with the entire sequence. Okay, so this is data you throw out, and this is the data you keep. And you have to pay more attention to the aggregated data of the 50-day moving average and so on and so forth. So when you look at a longer term chart, I can see this very easily. I mean, it's like, but again, there's an art to it. The 3,000 line. Now I know the 3,000 line is going to be significant. Where is this thing? So I know the 3,000 line is going to be significant. We have clear consolidation under the 3,000 line, right? Then we go over the 3,000 line, back to the 3,000 line, And then we have more consolidation under the 3,000, over the 3,000, and then we take off. So clearly, the 3,000 line was very significant. So this run, you would count being from the 3,000 line. Despite all these spikes and jags and whatever, this run came from 3,000. And where did the run go? From 3,000 to 4,400. But that's not 50%. So then you have to start looking, you have to start applying the rules, even though it didn't get hit yet. So 4,500, which we did hit on the, I don't know if we hit it, but 4,500 on the S&P, that's 50% up from 3,000. That is clearly the point at which we're going to retrace, clearly. And if that's true, that means that halfway between 3,000 and 4,500, which would be 3,750, should be some kind of consolidation. That would prove our theory. So here's 3,750. And was there consolidation? Yeah. See? Not a lot, but here, from here at 3,750. Wait, let me make sure I got the right line. 3,750, yeah. So here to here, you had consolidation around 3,750. So you'd expect some sort of pause around 3,750. It wasn't much of one, but notice how you got kind of jaggedy at this level, right? And that's not a short amount of time. That's like the whole first quarter we were at 3,750 or around 3,750. We broke over it, we held it several times, attempted to go below it, and then finally started moving higher. The next big test, 4,500. All right, so now that we're at 4,500, we still have a run. The main run is from 3,000. We're at 15,000 points from that, and that means your retraces are going to be 20% of the run is 300 points. So a weak retrace is going to be 300 points back. And that's 4,200. We talked about that before. We said 4,200. Below that is going to be 3,900. And that's all the 5% rule tells you. It's very simple. It tells you where to look for your consolidation points. It tells you where to look for your retraces. It tells you where you're going to look for the moves up. And it's all based on 20% of the run, but it's up to you to identify the run. So I'm telling you now that 4,200 is going to be a significant line on the way back down. We're going to come back down there and test it. And below, if 4,200 doesn't hold, and by the way, while we're testing 4,200, the 200-day moving average, because this is a weekly chart, the 200-day moving average is going to hit 4,200 also. So you would think that would be support. Okay, but the 50-day moving average is way below it. So if it takes, here's a strongly rising market, and how long did it take this to go up 200 points? It took it from June, July, August, September. It pretty much took, May, June. Where's 40? Sorry, 38 starts here. Oh no, actually it's June. Okay. So basically 2 months. It took 2 months to get to 4,000. It'll take 2 more months to get to 4,200. Even if the market stays really strong. If the market doesn't stay really strong, it'll take longer. So you won't have the support of the 200-day moving average. The 50-day moving average can turn down if this goes below 40. If we say that we're going to have a retrace of 300 points, that's going to be 4,200 down here. That's going to bend the 50-day moving average down. So I'm telling you what this chart's going to look like in the future. It's going to bend the 50-day moving average down when we test 4,200. That 50-day moving average, if we don't break quickly above 4,200, and that's only a weak retrace, we have a very good chance of going down to 39. But if we even hold 4,200, it's going to start bending the 50 down. The 50 is going to meet the 200 and death cross. And if we're still in this zone, when the death cross occurs, and that's going to go up in 2 months, and that's going to go down in 2 months, and it'll happen right here, which is August and September, late September, the end of September. So at the end of September, the 50-day moving average can death cross below the 200-day moving average on the S&P at the 4,200 line. It's going to happen right about the 4,200 line. And that, if the S&P is still at 4,200 at that time, it has a very good chance of reacting because so many people do trade TA. There's a very good chance of reacting to that and flying back down to 39 quickly, another 10% down. And that's what the 5% rule tells us. The 5% rule tells us that's the difference between the 5% rule and TA. The 5% rule tells us what's going to happen. TA only tells you what did happen, and then you get to draw all these extrapolation lines out. 5% rule says this is where your support is, this is where your resistance is. Now, will it be up or down? It could, by the way, that whole thing could be going the other way, and I could tell you how it's going to break out, but the difference is, where's the weighting of the market? What's going to happen over the next 2 or 3 months? Over the next 2 or 3 months, we're going to get a $1 trillion stimulus bill. The $3.5 trillion you keep hearing about is just the frickin' federal budget. It's not a stimulus bill. 3.5 trillion is the government's budget. There will be money moved around, but not a lot. Different things will get priority than other things, but it's the same money the government spent last year. It's going to benefit some people and not benefit other people. It is not a net positive for the market, the $3.5 trillion budget. The positive for the market is a $1 trillion or 1.2 trillion or whatever the hell they ended up with stimulus. But that's so much lower than last time. And if there's no new stimulus after that and people start realizing that the budget is just a budget, it's gonna take the onus out of this, not to mention the fact that inflation is really bad, consumer sentiment is diving, business sentiment is diving, the Delta virus is spreading. These are all problems in the market. So to me, it's not maybe it'll go up and maybe it'll go down. It will go down. I don't see how we can sustain 4,500 points on the S&P. Not to mention it's 40 frickin' times earnings. That's ridiculous. But the problem is, and I talk to people all the time, money managers and stuff. The problem is there's nowhere else to put your frickin' money. What are you supposed to do with the money? It's just sitting in accounts. Corporations have record amounts of cash on the books. There's nowhere to put it. Could they invest it? Yeah, maybe. They won't. They're not. The thing is, they're not buying back their own stock that as much anymore either, because that's too expensive. Even they realize it's too expensive. But what are they going to do with it? You can't buy another company. They're too expensive too. They don't want to buy equipment and plants and so on and so forth. All that stuff is still expensive. Labor is expensive now. And they don't want to put it in the bank because the bank doesn't pay them any interest. T-bills pay no interest. It's messed up. There's nowhere to put money. So that's where we are. So anyway, so to me, it's a time to be cautious. And cautiousness means have more cash in the portfolio, have less positions to worry about, make yourself more nimble. Let's be able to react to the market, whatever may come over the next couple of months. That's all. We're not getting out completely. I was thinking about getting out completely, but we don't need to get out completely because we have been of this mindset for quite a long time, and I've continuously raised cash. For months we've been raising cash. So when I did take a look at the portfolios, I'm like, oh, we already have $1.2 million. Now we're going to have $1.6 million. After all these cash outs, we'll have about $1.6 million. Same value, but 1.6 million less positions. So that means we've only got 20% of our portfolio value actually invested in the positions net. So that's great. That means even if that gets wiped out, we still have 80% of our money to put in, and we'll have 80% of our money to put in a significantly cheaper market. So that's an advantage. That's your hedge. Your hedge is the fact that the reason you lose your money. What am I hedging? I'm hedging against a loss. Well, what's my loss? The market drops 20%, and my portfolio loses it's $2.2 million. So the portfolio is $2 million. Let's say it loses $60,000 on a 20% drop in the market. It's 30%. So let's say we lose $60,000. on a 20% drop. That leaves me with $1.4 million. But everything in the market is 20% cheaper. And we aren't stock purchases, we're option purchases. That means we can then purchase the bull call spreads, the double and triple, when the market goes from minus 20% back to zero. We're in excellent shape when that happens. We can put our cash to work in blue chip stocks that go on sale. And it won't be if Pfizer drops from 50 to 40, which is 20%. That's probably not going to be the trigger, but some of these guys are going to drop a lot. AT&T, what if AT&T goes back to 25? They buy it hand over fist, right? $25 for AT&T, that's idiotic. If Wheaton comes back into the 30s, we're going to be going crazy and buying Wheaton precious metals. Look at Dow Chemical, Alibaba. Can Alibaba go any lower? We'll find out, right? Nope, the Disco we got rid of. Who else? Alibaba down. Gilead. Oh, HBI. If HBI gets cheaper, I mean, so if Dow sells off, if Gilead sells off 20% and goes back to 60, that's a nice pullback, but it's not enough. But if it went back to 50 or 40, forget it. Intel's already at a ridiculously low price. If they drop 20% to 40 something, we're going to be loading up the truck with Intel. There's tons of things we'd love to buy if they went on sale. And it's kind of hard to argue, right? Do we want Intel at 40 bucks? So we go back over here and we say INTC. It's $2 billion. It's a nice, easy number. So Intel, no, that's not Intel. It doesn't make any sense, that price. INTC. I'm like, that's too low. $200 billion, 213. So $200 billion company making $20 billion a year. Well, that's 10 times earnings. Next year they should make less, but still nice. But generally you can see 20, 20, 20, 20, a little bit less than 20. Who knows what they're doing, whatever they're doing. They're investing. And by the way, their new chips are amazing with the integrated video. So do we want Intel if it goes from 20 times from 10 times earnings to 8 times earnings to 7 times earnings? Yeah, absolutely. Absolutely want that for a long-term position. I don't want it at this price. I don't want more, but I sure as hell want more if it gets 20% cheaper. And that's what the cash is. Cash is flexibility. Cash is sitting back and waiting, and when a correction comes, instead of freaking out and screaming that you can't call your broker or he's not picking up or you can't get something sold or your online system isn't working, whatever, we just sit there and laugh, and which is what we did in March last year. We were just amused by the whole thing. We're like, oh, this is great. It's like, look at these prices. And you can see in our portfolios, we have a ton of stuff that we bought in that time period in March of last year, because we were sitting in cash. It was an incredible opportunity. And it's not an opportunity if you're all tied up in stocks and you're all invested in things and all you're doing is scrambling to try to salvage what you have. But if you have a huge amount of cash on the side, just like Warren Buffett always has, then when something happens, you don't worry about the positions that lost money. They'll come back or they won't. And they're not hurting you too badly, but the new positions that you're able to take are going to make your next few quarters. And that's what we're working on now. All right. So let's see if we have any last questions. Oh, Fed minutes. Oh, thank you. That's what it was. Fed minutes. Yep, you're right. On the button. Forgot about the Fed minutes. All right, so the Fed obviously said something that bothered somebody and blah, 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 blah. Let's take a quick look at that. Can't talk anymore. WSJ. Fed signals asset purchases. I said the headline in the minutes is, oh no, they're going to slow down. So the Fed's going to stop putting free money into the market, but slowing the pace of the asset purchases does not mean stopping it. It just means going from 120 billion to 110 billion to 100 billion, and they'll still be doing 100 billion at the end of the year. So it's like a 10% cutback or whatever in the whole thing. It's garbage. So yeah, I guess we took a tumble on the headlines, and then people actually read it and said, "Oh, this isn't a very big deal." So we'll see. I still think though on the whole we're going to head lower. I think there's people are starting to reassess a few things. Taliban hamper Kabul evacuations, crack down on protests. Taliban rulers meet their political protests with gunfire. Great. Oh my God. Oh, we're all getting booster shots. That's right. Did you guys see that? Everybody get a booster shot. Fed signals asset purchases like this was here. Oh, where's that thing yesterday? Oh, I didn't. Oh, was this it? Where was it? That's an actual thing in New York. That's official. That's in the glass. That's an official thing in New York. I love that. That's New York's policy. That's a governor who doesn't give a shit anymore, right? Rift forms on Didi's board after Beijing regulator assault. That's not good. What else is going on? Nothing. That's it. So it was the Fed. You're right. Thanks. All right. So, basically it's people react to the headlines. By the way, there's robots, there's algorithms that trade based on the headlines. They see a headline like this just like a human being. They read the headline and they react. And then people review it to decide whether or not they should stick with the trade the computer made. But there's a whole theory by these guys on Wall Street where they say that you can react to some news is obvious, and they're trying to make these things smarter and smarter so that they can read the headlines and immediately make trades based on that. You have trading houses that literally will buy and sell billions of dollars worth of stuff based on whatever crosses the computer, whatever crosses the headlines in the computer. It's crazy. Shed light, blah, 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 blah. Several officials favored tapering, blah, blah, blah. They're worried about inflation, blah, blah, blah. 80-40, we know, blah, blah, blah. See, you wonder how I can read so fast. I've read all these things so many times. It's all like repeat stuff. It's like reading the same story over and over again. Nothing. There's nothing here. Okay, so there's nothing here but the headline that says that the Fed is considering slowing their asset purchases, which of course they're considering that. And of course it's got to happen because this is insane. Oh, yeah. Oh, do they have that? Is that in the minutes? The balance sheet for the Fed? Who is that crazy? Let's see. Nope. Fed balance sheet. Recent balance sheet trend. Look at that. That's 8 million. $8 million. So this was last April. I mean, it honestly isn't that bad. It's from last April. Look what they did before this, though. From March of February 2020, in that amount of time to June of 2020, they went from 4.41 to 7.1, $3 trillion. They added $3 trillion, 75% boost in their balance sheet in a couple of months last year. It's like they snuck it in. They had an excuse, just like they did in 2008. They had an excuse to drastically expand their balance sheet, and they went for it. Here they had an excuse to drastically expand their balance sheet, and they went for it. And why is that? Because the Fed creates money but they have to have a reason to create the money. They have to, so when they get to jump in and be the white knight for the US economy, it's easy to be the white knight when being a white knight means you're going to take the United States' money and print more of it and then give it to the United States. But they're not even giving it to the United States, they're giving it to their bankers. They're buying out the assets of their member bankers. They're taking all the bad debt off the bank's hands. That's why the banks have such fantastic earnings while this is going on. They bought $4 trillion of bad debt in the last year. So of course all the banks had fantastic years. You have to be a complete moron to be stuck with bad debts right now. The Fed is buying them all up. They're buying all the T-bills. They're buying all the mortgages, everything. Anything you got a problem with, the Fed will take it. And the Fed doesn't care because the Fed itself will take those assets, and at the end of it, when they finally have to convert them or do something with them, they're only going to declare a profit or loss, and the profit or loss is directly charged to Treasury. Last year, the Fed made $300 billion in profit. That became a bonus for the US Treasury. Because the Fed can't keep that money, the Fed has to do it. But the Fed can make money for its members by buying off their bad debts. But then if they turn around and those debts turn better, and they turn better because obviously all the bailouts and assistance and whatever from the government. So now there's all these bad mortgages and bad loans and so on and so forth. The Fed said, oh, give them to us, we'll take it. Because they can sit on it for a while. They sat on it until things turned around, and they made a nice profit. And that profit then gets reflected in the Treasury. So the Treasury makes money. But the problem is when the Fed sells and has to sell at a loss, that gets added to our national debt. That's a loss for the US government. So the Fed can take that $8 trillion, declare a $2 trillion loss, and tank any government they want. They don't like an administration. All they have to do is take their losses and book it to that administration. And all of a sudden that administration looks like they can't handle the economy. It's really messed up. But what's mostly messed up is how these guys they went from 4.2 trillion to 8.2 trillion since last February. And now they're considering slowing down a little bit. This is nuts, completely nuts. And the market freaks out when they say they're going to stop doing this. We're not going to add a trillion. Not a trillion. Sorry, we're not going to add $4 trillion a year in debt anymore. And people are like, oh no, what are we going to do? So anyway, bottom line, we're cutting back our positions. We're going to go through the rest of the portfolios. We're going to figure out what we're going to keep and what we're going to get rid of. But the goal is much more cash. Sit out the month, wait and see what happens in after the holiday. After the holiday is key. So we're gonna, we got the holiday coming up in a couple of weeks. I guess it's like September 6th. It's a little bit late this year, right? So it's not the last week of August. It's the first weekend of September. And we'll see what happens. What are you gonna do? It'll be what it'll be. But I very, very much expect that 10% pullback. So we'll keep an eye on that and see what happens. Let's see how we're finishing up. Oh, back down again. Oh dear. But anyway, they can't keep this up forever. I mean, that's what I've been saying for months. I mean, it seems to be incorrect because I keep saying it and the market keeps going up. But the reality is you cannot just keep. Way to go. This. Oh, the Fed chart. You just can't keep doing that. You can't just create $4 trillion out of nothing every year. It's not real. It has consequences. They're just slow to be realized, but those consequences can be very nasty and very severe. All right, anyway, thanks everybody for coming. Appreciate it, and we'll do it again next week. All right, take care, everybody.